What's up, guys? Welcome back to another part of the reading series. Today is, I think, day 5 of reading The Big Short. We're gonna continue from where we left off last time. Let's begin while I eat my breakfast. Alright, I'm gonna start a timer right now. By the time Burry moved to Stanford Hospital in 1998 to take up his residency in neurology, the work he had done between midnight and 3 in the morning had made him a minor but meaningful hub in the land of value investing. But this time, the craze for internet stock were completely out of control and had infected the Stanford University medical community. The residents in particular, and some of the faculty were captivated by the dot-com bubble, said Burry. A decent minority of them were buying and discussing everything. Polycom, Coral, Razorfish, Pets.com, TIBCO, Microsoft, Dell, Intel are the ones I specifically remember, but ArioKiddingme.com was how my brain filtered a lot of it. I would just keep my mouth shut because I didn't want anybody there knowing that what I was doing on the side. I felt I could get in big trouble if the doctor saw I wasn't 110% committed to medicine. People who worry about seeming sufficiently committed to medicine probably sufficiently committed to medicine. The deeper he got into his medical career, the more Burry felt constrained by his problem with other people in the flesh. He briefly tried to hide in pathology, where the people had the decency to be dead, but that didn't work. Dead people, that part. More dead people, more that part. I thought I want something more cerebral. He moved back to St. Joe's, where his father remarried and been misdiagnosed by experts as bipolar when he shut down his website. And now he was quitting neurology to become a money manager. The chairman of the Stanford Department of Neurology thought he lost his mind and told him to take a year to think about it over. But he had already thought it over. I found it fascinating and seemingly true. He said that if I could run a portfolio well, I could achieve success in life, and that it wouldn't matter what kind of person I was perceived to be, even though I feel I was a good person deep down. His 40K in asset against 145K in student loan posed the question of exactly what portfolio he would run. His father had died after another misdiagnosed. A doctor had failed to spot the cancer on an X-ray, and the family had received a small settlement. The father disapproved of the stock market, but the payout from his death funded his son into it. His mother was able to kick in 20K from her settlement. His 3 brothers kicked in 10K each of theirs. With that, Dr. Michael Burry opened Shen Capital. As a boy, he loved the book The Science of Shannara. He created a grandiose memo to lure people not related to him by blood. The minimum net worth for investors should be 15 million, it said, which was interesting as it excluded not only himself but basically everyone he had ever known. As he scrambled to find office space, buy furniture, and open a brokerage account, he received a pair of surprising phone calls. The first came from a big investment fund in New York City, Gotham Capital. Gotham was founded by a value investment guru named Joel Greenblatt. Barry had read Greenblatt's book, You Can Be a Stock Market Genius. I hated the title but liked the book. Greenblatt's people told him that they had been making money off his idea for some time and wanted to continue to do so. Might Barry consider allowing Gotham to invest in his fund? Joel Greenblatt himself called and said, I've been waiting for you to leave medicine. Gotham flew Barry and his wife to New York, and it was the first time Michael Barry had flown to New York or flown first class, and put him up in a suite at the Intercontinental Hotel. On his way to meeting with Greenblatt, Barry was racked with the anxiety that always plagued him before face-to-face encounters with people. He took some comfort in the fact that the Gotham people seemed to have read so much of what he had written. If you read what I wrote first and then meet me, the meeting goes fine, he said. People who meet me who haven't read what I wrote, it almost never goes well. Even in high school, it was like that. Even with teachers, he was a walking blind taste test. You had to decide if you approved of him before you laid eyes on him. In this case, he was at a serious disadvantage, as he had no clue how big-time money managers dressed. He called me the day before the meeting, says one of his email friends, himself a professional money manager, and he asked, what should I wear? He didn't own a tie. He had one blue sport coat and funerals, for funerals. This was another quirk of Mike Barry's. In writing, he presented himself formally, even a bit stuffily, but he dressed for the beach. Walking to Gotham's office, he panicked and ducked into a tie rack and bought a tie. He arrived at the big New York money management firm as formally attired as he had ever been in his entire life, to find his partner in t-shirt and sweatpants. The exchange went something like this. We'd like to give you $1 million. Excuse me? We want to buy a quarter of your new hedge fund for $1 million. You do? Yes, we're offering $1 million after tax. Somehow, Barry had it in his mind that one day he wanted to be worth $1 million after tax. At any rate, he just blurted that last bit out before he fully understood what they were after, and they gave it to him. At that moment, on the basis of what he had written on his blog, he went from being an in-depth medical student with a net worth of minus 105K to a millionaire with a few outstanding loans. Barry didn't know it, but it was the first time Joel Greenblatt had done such a thing. He was just obviously this brilliant guy, and there aren't that many of them, said Greenblatt. Shortly after that odd encounter, he had a call from the insurance holding company, White Mountains. White Mountain was run by Jack Bryan, a member of Warren Buffett's inner circle, and they had spoken to Gotham Capital. We didn't know you were selling part of your firm, they said. And Barry explained that he didn't realize it until a few days earlier, when someone offered $1 million after tax for it. It turned out that White Mountains too had been watching Michael Barry closely. What intrigued us more than anything was that he was neurology resident, say Kip Albertine, then at White Mountain. When the hell was he doing this? From White Mountain, he extracts 60K for smaller pieces of his fund, plus a promise to send him $10 million to invest. And yes, said Albertine, he was the only person we found on the internet and cold called and gave him money. In Dr. Mike Barry's first year in business, he grappled briefly with the social dimension of running money. Generally, you don't raise any money unless you have a good meeting with people, he said. And generally, I don't want to be around people. And people who are with me generally figure that out. He went to a conference thrown by Bank of America to introduce new fund managers to wealthy investors. And those who attended figured that out. He gave a talk in which he argued that the way they measure risk was completely idiotic. They measure risk by volatility. How much a stock or bond happened to have jumped around in the past few years. Real risk was not volatility. Real risk was stupid investment decision. By and large, he later put it, the wealthiest of the wealthy and their representatives have accepted that most managers are average, and the better ones are able to achieve average return while exhibiting below average volatility. By this logic, a dollar selling for 50 cents one day, 60 cents the next day, and 40 cents the next somehow become worth less than a dollar, selling for 50 cents all 3 days. I would argue that the ability to buy at 40 cents presents opportunity, not risk, and that the dollar is still worth a dollar. He was greeted by silence and ate lunch alone. He sat at one of the big round table, just watching people at the other table happily jabber away. When he spoke to people in the flesh, he could never tell what had put them off, his message or his person. He made a close study of Warren Buffett, who had somehow managed to be both widely popular and truly successful. Buffett had had trouble with people too in his youth. He had used a Dale Carnegie course to learn how to interact more profitably with his fellow human being. Mike Burry came of age in a different money culture. The internet had displaced Dale Carnegie. He didn't need to meet people. He could explain himself online and waited for investors to find him. He could write up his elaborate thought and wait for people to read them and wire him their money to handle. Buffett was too popular for me, said Burry. I won't ever be kindly grandfather figure. This method of attracting funds suited Mike Burry. More to the point, it worked. He had started Sien Capital with a bit more than $1 million. The money from his mother and brothers and his own million after tax. In his first full year, 2001, the S&P 500 fell 11.88%. Skin was up 55%. The next year, the S&P 500 fell again 22.1%, and yet CN was up again 16%. The next year, 2003, the stock market finally turned around and rose 28.69%. But Mike Burry beat it again. His investment rose by 50%. That's crazy. By the end of 2004, Mike Burry was managing $600 million and turning money away. He had run his fund to maximize the amount he had under management. He have been running many billions of dollars, says a New York hedge fund manager who watched Burry's performance with growing incredulity. He designed Skin so that it was bad for business but good for investing. While capital raising may be a popularity contest, Burry wrote to his investor, perhaps to reassure them that it didn't matter if they loved their money managers or even knew him. Intelligent investment is quite the opposite. Warren Buffett had an ex-big partner, Charlie Munger, who evidently cared a lot less than Buffett did about whether people liked him. Back in 1995, Munger had given a talk at Harvard Business School called The Psychology of Human Misjudgment. If you wanted to predict how people would behave, Munger said, you only had to look at their incentives. FedEx couldn't get its night shift to finish on time. They tried everything to speed it up, but nothing worked until they stopped paying night shift worker by hours and start to pay them by the shift. Xerox created a new, better machine only to have it sell less well than the inferior older ones until they figured out that salesmen got a bigger commission for selling older ones. Well, you can say everybody knows that, said Munger. I think I've been in the top 5% of my age cohort all my life in understanding the power of incentive, and all my life I've underestimated it. And never a year passed that but I get some surprise that push my limits a little further. Munger's remarks articulate a great deal of what Mike Burry too believed about markets and the people who comprise them. I read that speech and I said, I agree with every single word of it, Burry said, adding, Munger also had a fake eye. Burry had his own angle on the same subject, derived from the time he had spent in medicine. Even in life or death situation, doctor, nurses, and patients all responded to bad incentives. In hospitals, in which the reimbursement rate for appendectomies ran higher, for instance, the surgeons removed more appendices. The evolution of eye surgery was another great example. In the 1990s, the op- ophthalmologists were building career on performing cataract procedures. They would take half an hour or less, and yet Medicare would reimburse them $1,700 a pop. In the late 1990s, Medicare slashed reimbursement level to around $450 per procedure, and the income of the surgically minded ophthalmologist fell. Across America, ophthalmologists ophthalmologists rediscovered an obscure and risky procedure called radial keratotomy, and there was a bomb in surgery to correct small impairment of vision. The inadequately studied procedure was marketed as a cure for suffering of contact lens wearers. In reality, says Berry, the incentive was to maintain their high, often $2 to $1 million income, and the justification followed. The industry rushed to come up with something less dangerous than radial keratotomy, and laser was eventually born. Thus, when Mike Burry went into business, he made sure that he had the proper incentive. He disapproved of the typical hedge fund manager's deal. Taking 2% of assets off the top, as Moore did, means the hedge fund manager got paid simply for amassing vast amount of other people's money. Skin Capital charged investor only its actual expenses, which typically ran well below 1% of the asset. To make the first nickel for himself, he had to make investors' money grow. Think about the genesis of Skin, say one of his early investors. The guy has no money and he chose to forego a fee that any other hedge fund take for granted. It was unheard of. Right from the start, Skin Capital was madly, almost commercially successful. By the middle of 2005, over a period in which the broad stock market index had fallen by 6.84%, Burry's fund was up 242%, and he was turning away investors. To his swelling audience, it didn't seem to matter whether the stock market rose or fell. Mike Burry found places to invest money shrewdly. He used no leverage and avoided shorting stocks. He was doing nothing more promising than buying common stocks and nothing more complicated than sitting in a room reading financial statement. For roughly $100 a year, he became a subscriber to 10K Wizard. Skin Capital's decision-making apparatus consists of one guy in a room with the door closed and shades drawn, poring over publicly available information and data on 10K Wizard. He went looking for court ruling, deal completions, or government regulatory changes, anything that might change the value of a company. Often, as not, he turned up what he called IC investment. In October 2001, he explained the concept in his letter to investor. IC investment means taking a special analytical interest in stocks that inspire a first reaction of IC. The alarmingly named Avent Corporation was a good example. He had found it searching for the word accepted in news stories. He knew that standing on the edge of the playing field, he needed to find uh, unorthodox way to title it to his advantage. And that usually means finding unusual situation the world might not be fully aware of. I wasn't searching for a news report of a scam or fraud per se, he said. That would have been too backward looking. I was looking to get in front of something. I was looking for something happening in the court that might lead to an investment thesis. An argument being accepted, a plea being accepted, a settlement being accepted by the court. The court had accepted a plea from a software company called the Avent Corporation. Avent had been accused of stealing from a competitor the software code that was the whole foundation of Avent's business. The company had $100 million in cash in the bank, was still generating $100 million a year of free cash flow, and had a market value of only $250 million. Michael Burry started digging. By the time he was done, he knew more about the Avent Corporation than any man on earth. He was able to see that even if the executive went to jail as they did, and the fines were paid as they were, Avent would be worth a lot more than the market then assumed. Most of its engineers were Chinese national on work visa, and thus trapped. There was no risk that anyone would quit before the lights went out. To make money on Avent stock, however, he'll probably have to stomach the short-term losses as investor put up share in horrified response to negative publicity. Burry bought his first share of Avent in June 2001 at $12 a share. Avent management then appeared on the cover of an issue of Business Week under the headline, "Does Crime Pay?" The stock plunged. Burry bought more. Avent's management went to jail. The stock fell some more. Mike Burry kept on buying, all the way down to $2 a share. He became Avent's single largest shareholder. He pressed management for changes. With the former CEO's criminal aura no longer part of the operating management, he wrote to the new bosses. Avent has a chance to demonstrate its concern for shareholder. In August, in another email he wrote, Avent still make me feel I'm sleeping with the village slut. No matter how well my needs are met, I doubt I'll ever brag about it. The creep factor is off the chart. I half think that if I pushed Avent too hard, I'll end up being terrorized by the Chinese mafia. 4 months later, Avent got taken over for $22 a share. That was a classic Mike Burry trade, say one of his investors. It goes up by 10 times, but first it goes down by half. This isn't the sort of ride most investors enjoy, but it was Burry thought the essence of value investing. His job was to disagree loudly with popular sentiment. He couldn't do this if he was at the mercy of very short-term market move. And so, he didn't give his investor the ability to remove their money on short notice, as most hedge funds did. If you gave Scan your money to invest, you were stuck for at least a year. Burry got designed his fund to attract people who wanted to be long the stock market, who want to bet on stock going up rather than stocks going down. I'm not a short at heart, he said. I don't dig into companies looking to short them generally. I want the upside to be much more than the downside. Fundamentally, he also didn't like the idea of taking the risk of selling a stock short, as the risk was theoretically unlimited. It could only fall to zero, but it could rise to infinity. Investing well was all about being paid the right price for risk. Increasingly, Barry felt that he wasn't. The problem wasn't confined to individual stock. The internet bubble had burst, and yet house prices in St. Joe's, the bubble epicenter, was still rising. He investigated the stock of home builders and then the stock of companies that insure home mortgage like PMI. To one of his friends, a big-time East Coast professional investor, he wrote in May 2003 that the real estate bubble was being driven even higher by the irrational behavior of mortgage lenders who were extending easy credit. You just have to watch for the level at which even nearly unlimited or unprecedented credit can no longer drive the housing market higher, he wrote. I am extremely bearish and feel the consequences could be easily be a 50% drop in residential real estate in the US. A large portion of current housing demand at current prices would disappear if only people become convinced that prices weren't rising. The collateral damage is likely to be orders of magnitude worse than anyone now consider. When he set out to be when he set out to bet against the subprime mortgage bond market in early 2005, the first big problem that he encountered was that the Wall Street investment bank that might sell him credit default swap didn't share his sense of urgency. Mayberry believed he had to place this bet now before the US housing market woke up and was restored to sanity. I didn't expect the fundamental deterioration in the underlying mortgage pool to hit critical level for a couple of years, he said, when the teaser rate would vanish and monthly payment would skyrocket. But he thought the market inevitably would see what he had seen and adjust. Someone on Wall Street would notice the fantastic increase in the riskiness of subprime mortgage and raise the price of insuring them accordingly. It's going to blow up before I can get this trade on, he wrote in an email. As Barry lived his life by email, he inadvertently kept a record of the birth of a new market from the point of view of its first retail customer. In, in retrospect, the amazing thing was just how quickly Wall Street firm went from having no idea what Mayberry was talking about when he called and asked them about credit default swap on subprime mortgage bond to reshaping their business in a way that left the new derivatives smack at the center. The original mortgage bond market had come into the world in much the same way, messily coaxed into existence by the extreme interest of a small handful of people on the margins of high finance. But it had taken years for the market to mature. This new market would be up and running and trading tens of billions of dollars worth of risk within a few months. The first thing Mayberry needed if he was going to buy insurance on a big pile of subprime mortgage bond was to create some kind of standard, widely agreed upon contract. Whoever sold him a credit default swap on a subprime mortgage bond would one day owe him a great deal of money. He suspected that dealers might try to get out of paying it to him. A contract would make it harder for them to do that, and easier for him to sell to one dealer what he had bought from another, and thus to shop around for prices. An organization called International Swap and Derivative Association, ISDA, had the task of formalizing the term of new securities. ISDA already had a set of rules in place to govern credit default swap on corporate bond, but insurance on corporate bond was a relatively simple matter. There was this event called a default that either did or did not happen. The company missed an interest payment you had to settle. The insurance buyer might not collect the full 100 cent on the dollar, just as the bondholder might not lose 100 cents on the dollar. As the company's assets were worth something, but an independent judge could decide in a way that was generally fair and satisfying what the recovery would be if the bondholder received 30 cents on a dollar, thus experiencing a loss of 70 cents. The guy who had bought the credit default swap got 70 cents. Buying insurance on a pool of U.S. home mortgage was more complicated because the pool didn't default all at once. Rather, one homeowner at a time defaulted. The dealer, led by Deutsche Bank and Goldman Sachs, come up with a clever solution: the pay-as-you-go credit default swap. The buyer of the buyer of insurance, would be paid off not all at once, if and when the entire pool of mortgage went bust, but incrementally as individual homeowner went to default. That's it for today. Right. I'll see you guys again in the part 6 tomorrow. Bye.